Oil prices are climbing again, and that could change everything from your wallet at the gas pump to the stock market, and even the direction of inflation. Rising oil is one of the biggest financial stories of the moment, and if history tells us anything, when oil moves, the world feels it. So today, we're going to break down exactly why oil prices are surging, what's driving this latest rally, how it affects inflation, what it means for different sectors of the stock market, the global political side of the story, and most importantly, what all of this means for you as an investor or just as someone trying to understand where the economy is headed. Let's start with the basics. Oil prices are back on the rise. Brent crude, the international benchmark, has been trading above $90 per barrel, while US crude isn't far behind. That's a sharp rebound compared to just a few months ago, when prices had cooled and many thought energy costs were finally under control. So, what's changed? Why are oil prices suddenly surging again? There are three big drivers: supply, demand, and geopolitics. On the supply side, OPEC and its ally, including Saudi Arabia and Russia, have been cutting production. Less oil on the market naturally pushes prices higher. OPEC knows this game well. When prices fall too low, they cut supply to force a rebound. And right now, those cuts are working. On the demand side, the global economy is proving more resilient than expected. Despite fears of recession, growth has held up in the US, parts of Europe, and especially in Asia. More growth means more energy consumption, and that demand is now colliding with tighter supply. Then comes geopolitics. Conflicts in the Middle East, sanctions on Russia, and instability in oil-producing nations all add to the pressure. Even the possibility of supply disruptions can send oil markets higher because traders build that risk into prices. When you put all of these forces together, shrinking supply, rising demand, and heightened political risk, oil prices don't just rise a little, they surge. Now here's why this matters. Oil isn't just another commodity, it's the lifeblood of the global economy. When oil prices climb, it creates a ripple effect across everything. The first place you feel it is at the gas pump. Filling up your car becomes more expensive, but it doesn't stop there. Higher oil prices mean higher shipping and transportation costs. Trucks, planes, ships, they all run on fuel. That makes it more expensive to move goods from one place to another. As shipping costs rise, the price of the goods themselves rises too. From groceries to electronics, businesses pass those extra costs onto consumers. And this is where inflation comes back into the picture. The Federal Reserve has spent the last 2 years fighting inflation with aggressive interest rate hikes. And for a while, it seemed to be working. Inflation cooled from its highs in 2022, but oil is the wild card. Rising oil makes everything more expensive again. That creates sticky inflation, the kind that doesn't go away easily. And sticky inflation means the Federal Reserve may have to keep interest rates higher for longer. Wall Street has been hoping for rate cuts to stimulate growth, but if oil keeps inflation elevated, those cuts may be delayed. So, in short, higher oil prices could directly slow down the Fed's plans, keep borrowing costs elevated, and weigh on the broader economy. But what does this mean for the stock market? Well, it's a story of winners and losers. The winners are clear. Energy company. When oil rises, companies like ExxonMobil, Chevron, and ConocoPhillips benefit directly. Their revenues and profits climb as the price of crude rises. That's why energy stocks often surge during oil rallies. But for the rest of the market, it's not such good news. Industries that depend heavily on fuel, airlines, shipping companies, trucking, and even manufacturers see costs rise. When costs go up, profit margins shrink. Take airlines, for example. Fuel is one of their largest expenses. A spike in oil prices can erase profitability almost overnight. That's why airline stocks often fall when oil jumps. Retailers can also feel the squeeze. Not only do their shipping costs rise, but consumers, facing higher gas bills, may cut back on discretionary spending. That hits demand for everything from clothing to electronics. So while oil helps one sector, energy, it can weigh down many others. That's the balancing act investors need to watch. Now, let's zoom out to the global stage. Oil is never just about economics. It's about politics and power. Saudi Arabia and Russia, two of the world's biggest oil exporters, are deliberately keeping supply limited to push prices higher. For them, higher oil revenue means more political leverage and more control over the global market. Meanwhile, the United States, though one of the largest oil producers itself, itself has an interest in keeping prices stable. Too high, and it hurts. American consumers. Too low, and U.S. shale producers struggle. The Biden administration, like many before it, finds itself caught between these forces. Then there's China, the world's largest oil importer. A rebound in Chinese demand puts upward pressure on global prices, and with China's economy in flux, oil demand becomes a key signal of whether their growth is stabilizing or weakening. And of course, we can't ignore the role of conflict. The war in Ukraine continues to disrupt energy flows. Any escalation in the Middle East could spike oil overnight. These geopolitical risks are why traders keep a close eye on oil futures. They're not just betting on economics, they're betting on global stability. So, what does all of this mean for you? If you're an investor, the lesson is simple. Oil prices matter, and they can shift the entire market. That doesn't mean you need to load up on energy stocks, but it does mean you should understand how energy trends affect your portfolio. For example, if you're invested heavily in sectors like airlines, transportation, or consumer discretionary, rising oil could be a headwind. On the other hand, if you hold energy stocks or ETFs, this surge could be an opportunity. If you're not an investor and you're just watching this from the perspective of everyday life, the message is still important. Rising oil prices can affect your daily budget, not just at the pump, but through higher prices for goods and services. It's also a reminder that the economy is interconnected. Oil isn't some distant market story. It's something that trickles into everything we do. So here's the bottom line. Oil prices are surging again. That means opportunity for some, pain for others, and big consequences for the economy as a whole. It puts pressure on inflation, complicates the Federal Reserve's decisions, creates winners in energy stocks, but challenges in other sectors, and adds another layer of tension to global politics. The big question now is, how high can oil go, and how long will it last? Some analysts say $100 oil is back on the table. Others believe this rally could fade if global growth slows. What do you think? Will oil keep climbing, or are we looking at just another short-term spike? Let me know your thoughts in the comments. And if you found this breakdown useful, don't forget to hit that like button, subscribe for more daily financial insights, and share this video with someone who follows the markets. Thanks for watching, and I'll see you in the next one.